The nice thing about crypto is that we have got data. In most other markets, the stock market for example, we don't really know who's buying, who's selling. We don't know how much accumulation there is. We can't really figure out what's going on behind the scenes. We only have prices. But with crypto and here with Bitcoin, we know more. And the investor that knows how to interpret the data better than most tends to make the money. Now what you see over here is an indication where Bitcoin got accumulated. So instead of looking at the activity by the time frame, we look at the activity by the price level. And when there's a lot of accumulation at a particular price level, we might have seen a floor and then continue rallying. Now if we zoom in a little bit, we can see that the current price level hasn't yet been that safely established. So since it's very hard to value Bitcoin objectively, since we don't have future cash flows in Bitcoin like we do with rental property or like we do with stocks, because we don't have that, we have to use other metrics. For example, the psychological anchor point of the market. Are people currently in profit or in losses? And that's why the supply change at different price levels matters. Now a lot of short-term money is currently in profit because the transactions happened around 93 to 95k. We might have to wait a bit longer until the new reference price is established at those higher levels. Now in crypto there are two mechanisms to determine prices. There are the decentralized exchanges where we've got liquidity pools. So capital providers just provide the funds in a pool, and then if you want to get altcoins out of that pool, you provide say the wrapped Ethereum and you get the altcoin back. So there is simply a direct mechanism. How is the ratio between the altcoins, in this example wrapped Ethereum, that determines the price. So that's mechanism number one. But then there's also the traditional mechanism, and that's an order book. So there are market makers that offer certain assets at a certain price, and then there are the takers of that price. And what we're seeing over here is the spot cumulative volume data for Binance in orange and for Coinbase in blue. When this is positive, it means that the takers generate a positive slippage on the price. So there's an overhang of people getting into the market, and the market makers see upward pressure on their price making. Now when this is negative, it's the exact opposite. We had been extremely negative at the end of March, beginning of April of this year, which then preceded a quite significant correction. But now things turn bullish again. And this is good, right? The more taker activity we have, the more likely we are going up. Now, besides the spot market where we've got these makers and these takers, we've also got the derivatives markets or the perpetual futures. This is simply bets on the price. So there are two parties that trade with one another, but we're not moving Bitcoin directly. We're just betting on the price with leverage. Now, in order to get that leverage, we have to pay a funding rate. Now, the higher that funding rate is, the more the short-term speculative money wants to bet on rising prices. And so when the funding rate is high, it means that the market is heated, right? The short-term money wants to get a lot of price action very quickly. But short-term money means it doesn't last forever. And so when this spiked, when Bitcoin hit the 72, 73k, that was also the end, at least in the medium term, of that bull run. We then saw again another spike, not as high, when Bitcoin was at around 100k, and now we are still comparatively low. We start to creep up again, but the market is definitely not as heated as it was when we were at 72k. And then, by the way, we dropped by roughly 25% in Bitcoin again. So it looks like the market is healthy. There is not too much leverage in the market, and we might just establish the current price for a while to then see another leg up. Now you might have heard this saying before. Bitcoin is a system that moves money from the impatient investor to the long-term investor. If you're buying Bitcoin and you just hold it over the next 5, 6, 7 years, you're likely going to be in profit because of tokenomics, right? The supply of Bitcoin is very much limited. The supply of fiat currency is not. Thus, the ratio of fiat to Bitcoin should improve over time. Bitcoin's price should go up. But what this also implies is that the short-term holders want to outperform the market, and it's player versus player. Now, historically, the long-term holders tended to find quite good exit opportunities. This is the Bitcoin value days destroyed. And this tends to peak when Bitcoin's price is also quite high. It doesn't have to be the perfect top, right? Bitcoin still moved from 40k to 60k when the long-term holders sold. Over here, it moved from 60k to 70k, and then of course subsequently to 100k when the long-term holders sold. But overall, when the long-term holders start to rebalance their portfolio, when they're overexposed to crypto, when they move their dormant Bitcoin, when the diamond hands, the whales, they suddenly become paper hands and thus destroy a lot of value days, it's also a good time to consider taking some profit. Currently, the long-term holders are not yet selling. Actually, they're doing the exact opposite. What we see over here is the long-term holder supply change. And again, we see how well the long-term holders time the ups and downs. They sold over here at 73K, then they bought back in at around 50K. They sold again at around 100K, and now they are buying back in massively again. They started with the purchases at 80K, but they continue to accumulate despite the price going up, right? Usually the long-term holders did the opposite. They sold on rising prices and they bought on falling prices, but now they are buying on rising prices. And I'm personally also quite exposed to the market because I believe there is a good chance that Bitcoin is going to hit 130, maybe even 140K in the quite near future. And one of the main reasons why I believe this is possible is this chart here. This is the stablecoin dominance. The chart starts in September of 2019 and it shows how much of all of crypto is currently in the stablecoins. Now in the first years we just saw stablecoin adoption, right? There was more and more stablecoins floating around, which makes sense. We then topped out at around 20%, then the stablecoin dominance went down, and in the last 1.5 years we are trading in a range. Now I want to show you the Bitcoin price development relative to the stablecoin dominance. When the stablecoin dominance was high, the Bitcoin price was low. When the stablecoin dominance was low, the Bitcoin price was high. As the stablecoin dominance rose, Bitcoin's price went down. Once the stablecoin dominance peaked, Bitcoin's price tended to go up. So there is a direct inverse correlation between the two. When one thing goes down, the other thing goes up. When one thing goes up, the other thing goes down. And if you work with the assumption that we stay in this trading range, if you continue to trade between 9% stablecoin dominance and 5% stablecoin dominance, and we think that maybe we continue to bounce like this, then there's a good case to be made that there's still some money on the sidelines and that all of that stablecoin money could get deployed very soon. If that of course happens, if the stablecoin dominance goes down, the Bitcoin price will go up. Now how much will it go up? Since we're already overlaying this part of the chart, this is the increase in the Bitcoin price. So it happened from the 7th of November to the 5th of December. And that's then how that looks like on the Bitcoin price chart. So again, 7th of November to 5th of December. We're taking the price development at the time, we're moving it to today. That brings us to a potential price target of somewhere around 130 to 140K. And maybe that's the reason why the long-term holders are buying. They also see how there's a lot of dry powder on the side, a lot of stablecoins that can still be deployed. And if they get deployed, we will see new all-time highs, and that will of course also attract new investors again. Now here's something very important to understand. Crypto is highly correlated, as in when the market tends to go down, everything goes down at the same time. There's very little variation. This is true for the bear case, but it's also true for the bull case, as in most things go up at the same time. There seems to be not so much benefit in diversification, as in it seems to not really matter what kind of token we buy. If we have 5 tokens or we've got 20 tokens, the portfolio tends to move in the same direction anyway. Now the reason for those synchronized ups and downs in the market cannot just be money flows, because the money is flowing in and out of the overall space relatively consistently with little volatility. What we've got over here is the stablecoin market cap. And since October of 2023, we tend to go up over time. So there is money getting into the system. People deposit their fiat currency, say on a centralized exchange. The centralized exchange then sends it over to a stablecoin custodian. The custodian holds the funds in a bank account and then mints the stablecoins on the chain. And we can see that minting, but also the redemption on this chart. So the volatility that all prices go up or all prices go down, it's not caused by money flowing in and out of the system as a whole. Instead, I believe it's caused by the swapping activity. So people going risk on or going risk off. So it's not the market as a whole expanding or contracting, it's the participants within the market that swap. And we can see that swapping activity with much more volatility here. So this is now the stablecoin dominance. We're not looking at the stablecoin market cap, we're looking at the stablecoin dominance. How much of all of crypto is in stables? And in the last 1.5 years, this tended to move in a range between 9% and 5%. And now compare that stablecoin dominance with the Bitcoin price. When the stablecoin dominance is low, it means the Bitcoin price tends to be high. When the stablecoin dominance is high, it means the Bitcoin price tends to be low. So there is somewhat of an inverse correlation. When people deploy their stablecoins, or when they're swapping from risk off to risk on, when stablecoin dominance goes down, prices tend to go up. And so because of that overall effect of market synchronization, because of the high correlation, things move in the same direction at the same time, it's not a good idea to just look at US dollar prices in order to make a good decision whether or not to buy or sell an altcoin. Because charts like this are also influenced by the overall market swapping activity, not just by the swapping activity within the altcoin. So for example, this here, right? This is Dogecoin. And who would have thought that Dogecoin already peaks at 46 cents when in the past it peaked at 56, 57 cents? Who would have already anticipated the peak earlier? How could we figure that out? Here is how we can figure that out. This is Dogecoin's dominance. And here those two tops align very nicely. And so a dominance chart is simply a chart that looks at the current market cap of an altcoin relative to all of crypto. So that way we remove the ups and downs of Bitcoin or of Ethereum. We are just looking at the relative performance of the altcoin versus the rest of the market. And again, that tends to trade in ranges. And that's how we can find out how the second peak should actually happen earlier in US dollars, because the dominance was already at historical heights. But check out this, right? This is Shiba Inu in US dollars. But here's Shiba Inu's dominance. So we do have a quiet, constant trend. Over time, Shiba Inu tends to underperform the rest of the market, and when we are high on the trading range, it might make sense to bet on falling prices. When we are low, we could potentially buy, but of course it's always somewhat risky to buy low when the overall trend is also bearish. So I personally prefer, when there's a declining trend, to look for short opportunities, so to bet on falling prices when we are high, and when we are in an upwards trend, to buy the dips. So when we are in a bull market, we buy the dips. When we are in a bear market, we short the top. And so Shiba Inu underperforms the market over the long term. So instead of trying to fish for bottoms here, isn't it better to just wait for the next short squeeze, to wait for the next rally in the price, to then bet on falling prices? Then the time is also on our side. Even if we see a bit of a spike above the regular trading range, we can just wait it out, because the overall trend is in our favor. That's not necessarily true when we buy, right? When we buy low in a declining trend, we might not find the exit on time and then have to sell again, potentially lower. Another example, here's Chainlink. And what we see over here, that's Chainlink's dominance. So just according to this chart, it might make sense to potentially buy some Link over just Bitcoin or Ethereum. Historically, it's rather cheap. Now, there are two central reasons why I like those relative valuation charts and those dominance charts. The first one is that we can actually see what happens specifically with that token, completely independent of the overall market. But the second reason is by plotting relative valuation charts, so say cryptocurrency A versus cryptocurrency B, we tend to see less volatility. We tend to see the trends clearer. For example, over here, this is the Ethereum price in US dollars since February of 2021. There's no clear trend. It's not necessarily easy to figure out when to buy or when to sell. But then we've got here Ethereum relative to Balancer. I like to look at this chart because it gives us two nice points. First of all, the overall volatility is rather small, but secondly, the gains are also extremely consistent. So this is an outperformance of 5,400%. This is how much Ethereum outperformed Balancer. And again, relatively speaking, with not that much volatility. Getting that much performance in a such consistent manner without having to time the market actively, that's quite unique, right? This is a risk to reward that we can only get with relative valuation plays. We can't get this just by buying something in US dollars. And again, the reason why everything in US dollars fluctuates so much is because the market as a whole goes risk on and risk off all the time. And that creates massive additional volatility. But we can get rid of that volatility. We can actually make money by buying this. Now, we don't just buy this, we have to set up a long Ethereum and a short balancer position. So to get this performance, we have to do a bit of quote unquote financial trickery. But yeah, why do we see such consistent outperformance? The reason is that balancer over time tends to have an expanding token supply. And a lot of that additional supply goes to liquidity mining. So to a lot of people that just get continued allocation to the token that then sell it off over time. And so this then differentiates the winners from the losers long term. The people that are willing to take one step further, they're going to look not just at the next 100x meme coin, it's likely going to go to zero, but that actually figure out what are the dynamics within the market and how can we profit from those dynamics. Those people tend to do better than just the people that buy and hold Bitcoin, for example. I have made dedicated tutorial videos on the topic. First of all, how do we even plot those relative valuation charts? How can we look at them? There's an entire tutorial section just on how to use TradingView in a proper manner and seeing the things that most people don't, right? Most people just look at things like this. This is not giving us any edge. But then there are also videos on how to actually execute those trades. How can we gain from relative valuations? How can we set this up? How can we continually make money with comparatively little risk? Now, most people here on YouTube are not willing to share their own performance, but I'm okay with doing that. I'm okay to share how much money I'm making on average over buying and holding Bitcoin. Because this is again where the big differentiator is. Everybody can get Bitcoin's performance, but actually the art in this is to make more than Bitcoin. If we take the time to trade actively, we have to outperform the benchmark. Now here are the monthly returns that I have made over buying and holding Bitcoin. So every data point is a month. This dotted line here is the 12-month moving average. And when we average out all of those dots, the monthly alpha over buying and holding Bitcoin for me is 2.1%. Now that might not sound like much, but that compounds over time. And then especially if we also add more money in the portfolio over time, we dollar cost average in, we have a quite nice smooth growth curve. So here's my active portfolio with trading and dollar cost averaging. And I hope that over the next 2 to 2.5 years, I'll be able again to double that portfolio. If we of course use leverage, we can make much more on a single trade. But I'm super cautious. I take very small bets. For example, have a look at this. I'm sharing my own trades. This is in the Gerhard Trade channel, and I opened again, based on relative valuations, a short of the Donald Trump meme coin. Trump relative to Solana was quite high, and it started to come down. And then our members also entered. They also had some leverage in there, so this was some gains. I waited a bit longer, closed this then at 141%. But because I only use 1 or 2% of my entire portfolio on a trade like this, the average alpha per month is only 2.1%. But if you're willing to take on more risk, you can of course grow much faster. Actually, our members do exactly that. So here's the channel, share your wins with some leverage and proper market timing and still reasonable risk management. There are several 100% in single trades easily possible. And so I think it's very important to forget about price targets, as in can Ethereum hit $4,000 or can Dogecoin hit $1, etc. Those kind of things don't really matter. What really matters is the relative performance. Capital within crypto moves from asset to asset. Attention moves from asset to asset. So there is all of the capital in the space. Sometimes it is risk on, sometimes it is risk off. But what really matters is where is the capital flowing to and where is it going away. And then all we need to do is to trade the relative valuation. It's much easier to make money that way. Again, would you rather hold this or would you rather hold this? And so yeah, feel free to check it out. It's currently $125 per month. You are locking in that rate. So when we come back to the 165 again in a few months, then you will still continue paying the 125. Whatever you're paying now, you will continue to pay. I will not increase the rate for everybody that's signing up now. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. There should be also somewhere a pop-up here on the right where you can click directly. It will lead you to the website. So see you over there. Cheers.